You want to know what the toughest part about buying a stock is? It's figuring out when to sell it. And one of the mistakes you'll see newbie investors often make is that they'll brag about paper gains. You'll see them on Twitter. I'm up 150%. Well, volatility goes both ways. And what you'll see is that a lot of newbie investors, and I've been there so I know this, start out with large paper gains and end up selling at a loss. And another mistake that you make early on in your investing journey is believing that you should set stop losses immediately after purchasing. And the old theory was that, well, market makers will take these out. Maybe, maybe not. The important takeaway there is you don't set a stop loss after purchasing because it shows no conviction at all in the company you're purchasing. If the stock price goes down, you should be buying more. That's why you invest in companies, not stocks. So most newbie investors don't have a predefined strategy for when to exit a stock. And when they do, sometimes they'll make exceptions for their predefined rules. So here at Nanalyze, when do we exit tech stocks? Well, we exit for two reasons. First, if growth stalls, it's revenue growth, because revenue growth is a proxy for market share being captured. And the second reason is if our thesis changes. Now, both these criteria allow for plenty of room for subjectivity, right? And the other thing that we'll do, I say exit for a reason, is that we'll trim large runners, and that helps balance our portfolio and reduce risk. Now, we often hear people suggest that we exit after a certain percentage loss, and that's not good, because if you exited Amazon after their 95% loss, you'd be kicking yourself. So you have to get accustomed to what they refer to as drawdowns and even add on drawdowns, but that's easier said than done. Now, our own tech stock portfolio, here's how we manage it basically. So we determine an initial position size, which is 1 divided by the number of positions that we have at any given time. We take that percentage and multiply it by current portfolio value. That monetary amount is the maximum that we're going to commit to that position. We establish a third at a particular valuation that we've decided. Wait a bit and see what happens. Then we use simple valuation ratio. That's market cap divided by annualized revenues. And we set targets. And then we add when valuation drops. Now, what happens when the valuation doesn't stop dropping? Well, we set a maximum to invest, as I just described, based on that initial position size that keeps us from trying to, as they say, catch falling knives. So when you take a holistic look at the assets we're managing, you see Nanalyze, that's our tech stock portfolio. It's 16% of our assets. The majority of our money is in Quantigents, our dividend growth investing strategy. So a total loss in the Nanalyze portfolio would decrease that tech portfolio by 2.7%. But when you put it into perspective, the impact on our total AUM is less than 1%, and that's as designed because tech is very risky. We can expect to have some complete losers. That brings us to Invitae. So we established a position in Invitae as a play on genetic testing. We invest in leaders, and Invitae was a leader, and we held that stock until the appearance of trouble. And around that time, it might have been one of the most difficult decisions to make. We'll talk about that. And when bankruptcy finally reared its ugly head, we finally exited at nearly a total loss. Now, the impact on our assets under management was minimal for the reasons I described earlier, but the situation is less than desirable, and we wanted to do a post-mortem and look at what lessons can be learned here. So let's start from the beginning. Before we get into that, I wanted to recognize the team of individuals that make these videos possible, and in particular, the people you see on the bottom row here, Stefan, Indira, Anna, and Wyatt. They recently accomplished a very significant task, and they're now producing these videos in Mandarin for our Chinese audience. So I wanted to send a warm welcome to our Chinese friends across the pond, and I'd invite you to come visit our website and read our research as well. We put out a ton of research, not just these videos. And Wyatt's going to put a link to our newsletter in the comments section, so please make sure everyone to sign up for our newsletter at Shishe and Ngoy. So a decade ago, we wrote this piece, Invitae Reinvents Genetic Testing, and this is pretty much the thesis in a nutshell. Invitae's strategy over the next several years is to, and whether or not this was a decade ago, so when they say several years, it certainly took them a longer time than that, but they wanted to aggregate all the world's medical genetic tests. So greater than 3,000 known genetic diseases into a single assay at a lower cost for all those than most single gene tests today. Totally understandable thesis, right? Now, this would have been 6 years later we wrote this piece, Invitae stock, a pure play on genetics testing, and there are some spooky premonitions in this article. And any of the articles I'm referring to, you can go to our website and search for them and look them up and read them for yourselves. Now, this was around the time Invitae acquired Archer. The revenue growth was strong. Their leadership seemed to be increased by that acquisition. But we said here, no matter how promising the thesis, every company can potentially implode. Companies like Invitae often end up burning through massive amounts of cash on a mission to go big or go broke. Burn rates don't just turn on a dime, and they'll need time to slowly transition the business to profitability. Well, they didn't have enough time, right? If funding dries up, and this is exactly what happened, they'll be pushed into increasingly unfavorable funding terms as time goes on. We pretty much spelled out what happened right there. So we went long Invitae at that time. We said there's also some regulatory risk, of course, but we believed that based on their aggressive pursuit of growth, both organic and acquired, that Invitae makes a must-hold stock for any investor looking for some pure play exposure to genetics testing. And the key metrics that we should have been watching were revenue growth, which seemed to be strong all the way until the end, gross margin, which was decreasing over time, but that was understandable as they were trying to compete on cost, perhaps a flawed business model that we should have been all over a little bit more early on. And cash burn. Cash burn is difficult because you're sort of at the guidance of management. And management, as you'll see in a little bit, wasn't very good at providing guidance. So the next time we checked in, this was in November of 2021, 1.5 years later, guidance was jumping around. So investors, we said here, punished Invitae because of their indecisiveness. So they said, oh, things are going great. They raised their guidance. And 3 months goes by. Actually, we were wrong. Things aren't going so good. That shows they don't have a good handle on their business, or perhaps the acquisitions that they were making. They acquired a lot of assets or firms. They didn't really know what they were acquiring. And when they discovered the skeletons in the closet, then things changed. So we said here, that inability to pick a guidance and stick with it doesn't bode well with investors who don't like surprises. So this is where the stock price started dropping. And we added to our position then. We said here, of course, we don't give investment advice. Do your own analysis and see if Invitae is a good fit. But we would feel confident adding to our current position while acknowledging the risk that the entire genetic testing domain is risky business. And we also said Invitae has raised $1.2 billion from SoftBank, giving them plenty of dry powder, but they're also blowing it like drunken sailors. They're acquiring other companies very quickly, and they fail to manage expectations. Understanding these risks, we don't see any reason not to add to our position because our underlying thesis has not changed. Remember, going to our earlier reasons why we sell a stock. When you look at revenue growth, you can see this would have been in November of 2021. Revenue growth was still going very strong. In fact, that year they realized 64% revenue growth. In 2022. That decelerated and plateaued. So 6 months later, and this is pretty much when all the damage was done, a rather spectacular decline here. We said over the past 6 months, shares of Invitae have dropped more than 80%, leaving us with a position that's now 86% below our cost basis. So at that point in time, we had pretty much lost most of that position. And we said here, as we always say, the only reason to sell a stock is if growth subsides. It hadn't, or our thesis changes. It hadn't. Invitae is a leader in genetic testing with revenue growth that shows no sign of stalling. Now, at this point in time, most of the damage was already done, and I'm not entirely sure that we would have made a good case to exit with the 14% we had remaining. And we said in that article that one of the outcomes would be that, could be, Invitae pulls an Amy Winehouse. So we said if Invitae defaults because they took on some dangerous debt, and they did, and we spoke about it in this article, shares will probably pull a Bind Therapeutics and be worth F all. That's what happens. We said if that happens, we need to know how much we stand to lose. The answer is not much. And we go on to say diversification is important because it allows you to make mistakes without ending up in the poorhouse. Invitae is a great example of why we don't sweat paper losses. Even if the company went bankrupt, we identified at that time 0.66% impact to AUM. And we said that's why we always limit the amount of capital invested in any single stock. So we were proceeding correctly at that point in time. Then we identified some cash flow problems. So they had at that time $885 million, some convertible notes. We said, here, now that capital markets have dried up, they seem to have been caught with their pants down as the tide goes out. Raising capital is no longer easy or cheap. Remember earlier we identified that as a potential risk, so we were spot on there. And then the company was talking about becoming cash flow positive in 2025. We had concerns about how they plan to raise that money, and we said, here, they may have backed themselves into a corner with some pretty restrictive debt obligations. You can read in that piece. I don't know why they did what they did with that debt, but it was very risky, a big pile of it, and a share price that will only serve to dilute existing investors if they sell shares to fund their operations. So that article delved into the inexplicably risky debt financing they took on. Then, in March of 2023, this piece here, Falling Out of Love with Invitae Stock. We said there, the reality is for 2023, revenue growth for Invitae will be on the decline for the first time. If genetics testing provides loads of value, then it should be selling itself, and it's not. And I can't underscore at that time, and you can read that article if you were around, and that wasn't very long ago, just last year, how contentious that stock had become. Loads of people coming around saying this thing is gonna, it's gonna turn around. They had a turnaround plan. I believe they had a new management team. And I think, honestly, that was one of the most, remember, we already lost most of our money in that position, but it was probably one of the most difficult decisions to make in terms of, do we exit? Because remember I talked about subjectivity in revenue growth. At that time, that was the first year that they were expecting revenue growth to stall, but they had all these big plans and it became a turnaround story. So maybe a takeaway here is once a company becomes a turnaround story, get the hell out. So takeaways. Beware of growth at all costs. I think in the past and even present, when we're looking at investing in disruptive technologies, we want these companies to be capturing market share as quickly as possible. But we need to be very careful about those companies with a business model that involves spending $1 to get 90 cents in revenues. And early on, we talked about how Invitae may be subsidizing their products to capture market share to keep that leadership position. So we need to pay closer attention to gross margins. I think we've gotten better about that. Now, that really shows the potential for profitability. And it's a red flag when companies acquire too fast. I think that in the SPAC era, we've seen a bunch of that where they go and acquire growth with their new windfall. So I think with Invitae, we should have exited when those cash flow problems emerged and that risky debt reared its head, and we would have captured the 14% of the position that remained. Now, just some parting thoughts here. This was taken from a November 2021 article we did titled Myriad Genetics Stock versus Invitae Stock. If you stick your neck out and make a long-term call on a stock that turns out to be right, expect to hear nothing but crickets later when you're proven right. But if your call turns out to be wrong, people will be lining up around the block to point out what an idiotic buffoon you are. That's human nature. And it's partly explained by the concept of loss aversion. People feel the pain of a loss twice as much as the joy of a gain. And I think another lesson that we can take away from this is we should never be afraid to exit a position, even at a loss. So I'm going to put up another video here that you might be interested in. Before you watch that, before you go into the comment section and tell us what you think, please make sure to like this video. Thanks so much for taking the time to watch this today.